Every year in his letter, Buffett gives an assessment of the company, highlighting what he thinks are the most important performers. And this year, for the first time, the investment in Apple made that list. Berkshire owns 5.4% of Apple, which, based on Friday's closing price, is worth almost $110 billion. Buffett called it one of Berkshire's family jewels, along with Berkshire's property and casualty insurance group, its Burlington Northern Santa Fe Railroad, and Berkshire Hathaway Energy. Berkshire paid $36 billion to buy that Apple stake. It accumulated the purchases starting in late 2016, and it went through the middle of 2018. And since then, it's sold a small part of the stake for $11 billion. It's also received more than $2.3 billion in dividends from Apple. So all in, that means that it's closer to $22.3 billion that they paid for the stake that is now worth almost $110 billion. He writes, in its brief 232 years of existence, there's been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. Never bet against America. And guys, for the comments on the markets, they were actually pretty sparse this time around, but he did say that bonds are not the place to be.
His messages are very clear, which is it's hard to find cheap stocks if you're value investors. He didn't like bonds at that point, and he believes in America, as we all do, and he doesn't want to fade the US, which I agree with. So if you put all these three things together, it leads him to buy back his own stock. And it speaks to a very important signal to investors is whatever you do at this point, make sure you know really well what you're buying.
Basically, the nature of what he looks at is cash flow, quality of the cash flow, and evaluation on that multiple of cash flow. So in terms of my reading of it, not his, he doesn't talk about the conglomerates except for the pointing out that investment bankers love it, pushing an illusion. The illusions last for a long time. He goes back to the 60s when I was there watching Charlie Blue Dawn, Jimmy Ling, Janine, and so on. The conglomerates were looking at things to try to put together a cycled position for Wall Street. But he uses that analogy, Becky, also to talk about today as to how companies are put together, for Wall Street, not necessarily for operating cash flow. There's a lot of detail. For example, in Clayton, he talks about how well they did in the annual. But if you go into the details, they only sold 2.5% more manufactured housing. And when you blend them together under his orchestra leader, how does he look at that? So I would think in quotes, the conglomerate discount has value. A lot of companies that I follow sell at a discount for what I think the takeover price would be. So if you want to take over Berkshire, you're going to pay a much higher price. You're not going to do it because it's unlikely. And then what is the benefit of splitting it up? When you split it up, you got $280 million, of which $130 million relates to the float that he's got in the insurance company. So there's a lot of moving parts.
As for the markets, the mistakes that he admitted, Berkshire took on an $11 billion write-down last year. Most of that was for Precision Castparts. That's a manufacturer for the aerospace industry that it bought back in 2016 for $32.1 billion. I paid too much for the company, Buffett wrote. PCC is far from my first error of that sort, but it's a big one. Now, for the criticism of corporate America, Buffett took conglomerates to task and explained why most of them stink, of course, present company excluded. The big problem with most conglomerates, he said, is that they only buy other businesses in their entirety. And that limits the pool of available businesses because most great companies don't want to sell out. It's also exacerbated when the conglomerates then agree to overpay for those companies that they do buy, often with an inflated stock price of their own. He writes, Wall Street loves the fees that deal-making generates, and the press loves the stories that colorful promoters provide. At a point, also, the soaring price of a promoted stock can itself become proof that an illusion is a reality. Eventually, of course, the party ends and many business emperors are found to have no clothes. Conglomerates earned their terrible reputation.